Hello and welcome to the first episode of the House of Investing. My name is Jason. I'm the founder of Streamlined Finance. And why should you follow me? Well, I'm now up by about 40% this year. Compare that with the S&P's result of 13%. And the idea of this podcast is to show you how you can become a better investor too by following the same approach as I do. So I'm going to be teaching you like how I approach investing. We're going to cover stock news, we're going to cover market analysis, and we're also going to dive into separate stocks individually. So this is going to be a less produced video, more of like a podcast style. So I allow myself to fumble over words and stuff like that. I'm not a native English speaker. I'm actually Dutch, based out of Dubai. So let's dive right in. So first things first, let's have a look at the market. So when I look at, let's say, the S&P's charts, right? So one thing I've learned is that hedge funds, when they assess their market regime, so they use different modeling. For example, they use a hidden Markov model. I've tried it myself. I am a programmer, so I know actually how to code it. But what I found is that hidden Markov models, they are very good in predicting the past, but not very good in predicting the future. And basically, the number one, or maybe the number one and two indicators that they use is actually the price itself and then volatility. So here we can see actually that, all the way in this period, the price is very stable. And then now we have a period of volatility. Now the price appears to be more stable before we close out this year. So we are probably looking at, coming just out of a period of volatility, and it's stagnant. Right now, we see that actually the price is not moving by a lot right now. And my guess is that it will probably remain like this until the midterms. We've seen just in the last few weeks a lot of question marks regarding the AI bubble. Yeah, whether that's true or not, it depends, on your perspective. We have seen Google come out with its own TPUs, and this puts into question whether NVIDIA is going to remain dominant in its market position. Even Apple is producing its own factory to produce its own chips, but that's all in the future, right? And Google's only one customer. Meanwhile, NVIDIA's expectations are still quite, optimistic. Really, like if we look at NVIDIA, for example, the question is really like, is this trend going to continue as is? Because the expectations basically assume that it will be, right? And then, based on these expectations, NVIDIA's forward earnings ratio is 25. And now, if you don't know if 25 is a lot or not, right? So what we can do is we can compare it with Google, for example, right? So here we see that actually, if this trend is to continue, then NVIDIA is actually cheaper than Google in this metric, right? So that makes NVIDIA still quite attractive. Let's say that, that we discount this by 20%. Well, then we're probably looking at a difference here. Where it becomes more similar to Google, right? So that's one thing to consider when buying NVIDIA, if you're going to buy it. I do think that, based on the price, it looks like it's in a downtrend, right? But then also there's quite a bit of support here. So it could be a good entry here, but consider a stop loss perhaps here below this low here. That would be a good point. But, what I would like to show you is how I approach and find companies. So maybe one thing that I like to do is when I find a company, I compare it to Microsoft. So this is my benchmark, basically. Is the company better than Microsoft? And why do I pick Microsoft? I think that historically, like if you zoom all the way out, it's quite a stable stock. Despite these swings, but this is very similar to the S&P. Like if you look at the S&P, right? So if you zoom out, so this is February 2025, and this is February 2025. So you see here that both, go in tandem down and up. Of course, the S&P is more stable, but look here. This is very, very stable of Microsoft, the earnings and the revenue. So basically, when you are trying, or when you find a company, the question is, okay, is it growing faster than Microsoft? Because if it's not, then why not just buy Microsoft, right? Yeah, and you could buy Microsoft, for example, in these swings. Like you could buy here, you could buy here, you could buy here, you could buy here. So how do you do it, right? Like I managed to find a couple companies that performed very well this year. Like I have a whole list here. So maybe I can sort by, let's say, 1 year. Yeah, so here, I have all of these. Now, how did I find these, right? How do you find such companies? Well, these are actually in the theme of the data centers. So NextPower, it's actually a solar company. The problem actually with solar companies is that they usually have very low margins. But the thing about NextPower is that they actually have healthy margins of 17%. So what do? So they basically provide the solar tracking solutions for PV projects. So it's basically for solar projects. So they're making the trackers that follow the sun. So if the sun goes like this, it will basically follow the sun. So they have healthy margins, and we know that this industry is growing. So here, if we see the, earnings per share, we see that there's growth. And look here, the revenue is 20% growing. So that's more than Microsoft that we just saw. And then another thing is, look at the valuation. It's lower than Microsoft. Here, if you compare with Microsoft, then we see, right, like the price to earnings is 32% lower, price to sales is 67% lower, the revenue is 30% higher. So this is a good company to buy, right? Especially if you believe that all these data centers require more power. Well, if they're going to use solar, they're going to probably use solar trackers. And then NextPower is a good candidate. So that's one. Now, how did I find these, right? So on Streamlined Finance, we have a stock screener, Find Stocks page. And basically, what Steve Jobs said is, if you want to grow a company, you have to focus on the top line. So that's the revenue. So we can find, companies by revenue. And then if we include the Russell 2000, then we include small cap companies. Now, I like to not look at 1 year because you might get weird results. Like if you open this one and if you look at the revenue, so it went from 800 to 77. And what do they do actually? Also, it's operating in energy, Creek Road miners. So basically what I do is I first try to understand, right? Like what does this company do? Well, one thing, if you can see the price totally tanked. So would I buy this? Probably no. And the volume is also very low for a company, and the market cap is also very low. So my guess is also that the float is going to be low, which you'll see here. Yeah. So see, the insiders, they have about 50% of the shares. So there's very low volume in a company like this. So we see that they invest about 390 million in build out. So they might build a factory for their power. And how would I go about understanding the company? Well, one quick way is actually using the AI management discussion and analysis. So this takes about a minute or two. Okay, there's no text to summarize. Well, then we can look at the 10K or the 10Q. Here's the 10K. So the 10K usually has better information. So here, management discussion and analysis. So here we get a sense of what the management is saying about the business. So if you're looking at a new company like this one, I don't know about, then this is a good way to understand what they do and what their future projects are. So if we read the overview, independent oil and gas company focused on the acquisition and development of crude oil, natural gas, and NGLs. Okay. Our assets and operations are strategically located in the oil region of rural Weld County within the DJ Basin. We believe DJ Basin to be the premier resource place in the U.S. Weld County, both some of the lowest break-even prices. So it's basically a oil and gas company. We seek to deliver energy and environmental. In addition to growing production through drilling operations, we seek to grow our business through accretive acquisitions, focusing on assets, the following criteria: producing reserves, opportunity to add accretive. I don't even know what this word means. Characterized by gradual growth or increase. Okay. All right. Recent developments. So, Bayswater acquisition. So they acquired another company, it seems like. Okay. Development program launch. During the third quarter, we commenced our initial drilling program. Third quarter of 2024. So if you see here, right? Third quarter 2024. If you remove this one. Yeah, you see, this is what they spent, about 20 million. So that was probably for that program. So where did they spend 392 million on? Right? This is the question. Actually, they didn't spend it. This is the free cash flow. Okay. They are very, very cheap. So it's a very unknown company. They have just acquired Bayswater. What do we know about Bayswater? I don't know anything about Bayswater. Let's see if you read their last quarterly report. And if we summarize it, let's see what it says. Now, with such companies where you have very low information, when you invest in a company like this, you should obviously use a very small size. Like one thing that I advise, like I invest maybe in like 10 to 15 companies. And if you're like me, like I am not fully on top of all the news of all these companies. So I like to keep more than just, a handful. I like to keep 10 or 15, because what might happen is one negative earnings report and all of a sudden, boom, the stock can drop by like 10, 15%. And if this is one of your big holdings, or let's say you have 20% allocated to this company, well, that's a big hit to your portfolio. So I like to keep many companies, and the more I know about the company, the more comfortable I am putting more money into it. So a company like this, like if I decide to invest, I would keep, a couple percentage maximum to a company like this. And then also you have to think about, okay, what is the industry, right? So in this case, oil and gas. Is your company already heavily invested in the same industry? Because then they're going to be highly correlated. And then another thing is like in the market regime where it's bullish, where the money typically flows is in high growth tech companies, biotechs, and that kind of thing. This would be very reliant on the oil price. So you need to then also watch the oil price. All right, so here we get the summary. Bayswater acquisition, so this we found out, and also Edge acquisition for 12.5 million. They had a credit facility and various debt instruments. Okay, so they may be highly levered. If you look at that, we see here the debt to, so they have about twice the amount of debt as equity. Okay, that's a good thing to understand. And then if you go back here, see the market risk, the company faces risk from commodity price volatility. Like I said, it's correlated to oil itself, oil and gas. Operating lease cost increased. Okay, issued Series F preferred stock raise. See, this is good to know, right? So basically, if you're holding this stock, the way they basically raise capital is through the stock market. So they basically issue more stocks and they're going to raise from investors. But this means that your stocks are going to be diluted. So this is bad for the stock price. And this might be, like why we have seen such a decrease here. And here, if we see that indeed, like the amount of stock that's outstanding keeps increasing. Yeah. What else? Cash flow. Okay. I'm just reading here. Despite the revenue growth, the company experienced a net loss for 22 million. So if we look here, we see indeed a net loss, right? So, would I invest in this company? It looks like they're still early stage. They have indeed increased their revenue by a lot. So what we could do in this case, you add it to the watch list. So now it's on the watch list, and we can keep an eye on it. And if we see, for example, a reversal in the price, then that could indicate that maybe we could step in and take some profits on that while it's going up. But now I would not buy it because I don't know much about this company. There's a lot of question marks. Yes, the revenue has gone up, but this is 77 million revenue where they spent, how much did they spend again on acquiring those two companies? See, 602 and 12.5. So they need to make a lot more to get this back, right? So maybe you put it on the watch list, and then next quarter you can have a look at it again and see how it performs. So now going back, so let's try to find a good company. So again, I look for small cap companies because that's where usually the opportunity is. Everybody's looking at the big cap S&P 500 companies, but this is usually not where you can find a lot of upside. Yes, you can find companies that grow 20-30%, but where do you find companies that could potentially give you like a 50% return? Well, now you need to look in places where not many investors are looking, right? So let me make sure that I'm still filming, and we are. So we go back again to the revenue. What I want to do is I want to select 3-year. So we're going to look at the 3-year period. And then we're going to see, okay, which companies are showing up here. And then we're going to look at them one by one. Now, I don't know much about pharmaceuticals and biotech. So this is not my area of expertise. So I'm going to click on the first one where I might know something about. So Geron Corporation. So I don't know any of these. So just so that you know. So let's have a look at Flagstar Financial. Operates as the bank holding company for Flagstar Bank that provides banking products and services. All right, so what do we see? We see that actually their 3-year revenue increased because before they were making almost none. And we see a downwards trend. So that already can tell me that this is not a company that I want to invest in because I want to see an upward trend. So this was basically a false positive. Now, Geron Corporation, immediately right off the bat, I can see that they're also not profitable. If you look here at the revenue, yes, it has gone up, but they're not profitable. So would I invest in a company that's not profitable? I wouldn't, unless I really know the company. So let's click these two aside and let's move on to the next one. So I see therapeutics, pharmaceuticals, and you see here Bancorp. So let's open a few more. Also a bank holding company, Security Bank. Now this looks better. It's at least profitable. This is the earnings per share we're looking at. And this doesn't look great. This may look like there's not enough data or incorrect data. But it's, if you compare this, right? So this is 65 and this is 27. And this was in 2019. So let's say, 35 38, 38.5 divided by 27.7. So they basically had an increase of 40% in their revenue in, no, it's almost 2026. So like 6 to 7 years. Is that enough? Well, if we discount compounding for a bit, then we see, actually we cannot do that. So -1. Okay, this is just a very quick calculation. So they grew about 5% if you do time hundreds. So 5.5% per year in revenue. Now, is that more than Microsoft? No. So right off the bat, not interesting. Then we go here to OppFi. It operates as a financial technology platform that allows banks to offer lending products. Okay, let's have a look at their earnings. So it goes from positive to negative. And also this data looks incorrect. This data looks incorrect. If we remove this one, what do we see? Just this one earnings looks incorrect. But you see here already that their revenue is below the expectation. These are the estimates here. And then these are the realized revenue reportings. So also not interesting. Ardelyx, biopharmaceutical company. Like I said, this is not my area. But at least we see, revenue growth. This is in fact very good growth, right? This is very, very good growth because just year over year, 58% in 1 year. So this is exactly the type of company that we like to see in terms of revenue growth. But let's scrutinize it because it's not profitable. In fact, it's only had a few quarters where it's profitable. You see? Now, it might be that they are reinvesting. So they might actually, or they might be able to reach profitability if they do not invest. But if we look at the capital expenditure, in fact, it's very low. So why are they not profitable? And also here we can see that they keep issuing shares, though it has been quite stable since 2024. So if you can uncover that maybe there are plans, to capitalize, or maybe they have finally reached a stage where they do not need to raise capital anymore. Maybe they have actually reached the stage where they think that they can turn profitable here. And in fact, if you see the expectation for next year in the third quarter, it's in fact positive. So now this might be a company worth investigating. So what does it do? It discovers, develops, and commercializes medicine to treat gastrointestinal and cardiorenal therapeutic areas. Okay, so it's for people with irritable bowel syndrome. All right, let's see if we can use AI here for distilling management discussions and analysis. I like to look at this. I like to also look at business outlook. But this, what it's basically doing is it's taking it from the annual report and summarizing it for us. So we might miss some details, but it's a quick way or easy way to quickly see what they do. All right, so we are a biopharmaceutical company focused on discovering, developing, and commercializing innovative medicines. Our first product, tenapanor, is approved. All right, so, this is their first product, so you can look, for example, here, what the community says that it does. See here, I see, for example, several months ago, provided me with samples for chronic constipation. I was impressed with how well it worked. So you can just find it, right? This information. Product sales reached 319 million. Our strategy focused on maintaining commercial momentum. All right, revenue was up 168% from 2023. So this is a high growth company, exactly what we're looking for. Operating expenses. So here they explain why their expenses increased. Operating expenses rose driven by increased R&D and selling general administrative costs to support product commercialization. Okay, that's a very general way to explain it. We believe our cash and investments will be sufficient to fund operations for at least the next year. So they say that they have enough cash and investments so that they do not have to raise more capital through equity dilution. So that's good for investors. And probably this 10K came out last year. Where do we have it? Here. February, in fact. Okay, so it was early this year. All right, so this is also a company that I would probably favorite. I would learn more about it. And once I know more about it, I can potentially invest in a company like this. See, one thing I immediately like here in the price action is that it's changed from the downtrend to an uptrend. At least looks like it. Because here we have a higher high and a higher low compared to here. And now it's here at the bottom. So for a quick trade, this could be a good entry actually, with stop loss here, so that it can continue this trend. So that's kind of like how I approach it. What else can we talk about here? Yeah, one thing that I saw, because now earnings seasons has come to an end. And on this page, we can actually see all the quarterly earnings by stock, and we can filter by earnings growth and revenue growth. So basically, it's the similar philosophy. Like you find companies that are growing, and then you're going to analyze them one by one. And then when you find companies that you understand, that you like, then you can invest in those. And then, keep like 10 to 15 of those stocks so that you kind of diversified. Then when anything bad happens to one stock, at least it doesn't affect your portfolio that much. So you're basically finding a group of companies that are growing faster than the average. And this is exactly like how I managed to outperform the S&P. All right. So here is, for example, Robinhood. Let's have a look at Robinhood. AppLovin is a company that I made money on. And we're going to also look at Coinbase and Palantir. So let's look at these four companies, right? So this is from this earnings season. They have reported a high revenue growth. These companies are from the S&P 500, but the process is the same. So what I would do, I already understand what Robinhood does. In case you don't, it's a investing platform. Let me just make sure we reset this here. So it's an investing platform that has very good growth. In fact, 74%. So right off the bat, better than Microsoft in terms of growth. So plus. Then I would look at the valuation. And by the way, you can look here at the valuation, and you can look here as well. So here we can see, right, that the growth value or the growth score is 9.6. So it's very good in terms of growth. The quality is also very good, 8.9. So this looks at, the profit margin, so 52. So this is indeed very good for a company. Exchange broker type of businesses, they usually have very good models. And that's why Coinbase was probably also in the list to look at. So here we look at stock value is 4.5. So it is a bit on the higher side. So here we see the price to earnings is 50. And that is indeed on the higher side. Like if you look at the S&P average now, the S&P's average is 30. So it is 66% higher. But look here, the average growth rate of the top line of the S&P is 7.1%. Whereas here we're 10 times, almost 10 times more than 10 times in fact. So you have 10 times higher growth, but you're not paying 10 times the price. And the way markets usually work is that the money is usually allocated to growth capital. So it is normal that a company like Robinhood has a higher valuation because it has a higher growth rate. The company is growing faster. So to me, this looks like, based on the current market conditions, this looks like a fair valuation based on what I've seen. But one thing that stands out here is that the price to sales ratio is much higher. And that is partly because the markets will look more closely at the price to earnings ratio. And since, Robinhood has a much higher profit margin than the S&P, we can probably ignore this statistic and look better at the price to earnings ratio. Now, what else would I like to see here? Are they still raising capital? So that's something that we see here. So shares outstanding is the total amount of shares that are there, and shares float is the shares available to common investors. So this probably means that insiders are selling and making it available to secondary markets where you and I could buy it. So the fact that this is going up and this means remains steady, it's actually good. That's a good sign. Because that means that, let's say that an insider decides to sell, it won't affect the market as much. It won't affect the stock price as much. So that's exactly what we'd like to see. And indeed, here, if you look at the inside trades, we see that they are mostly disposing their shares. We see here the dates. So what else? Yeah, here we can see that in the past, the valuation has been much higher than it is now. And I think also the company in itself, it's more stable than what it used to be. Now, if we look here at the free cash flow, we see that it's quite seasonal. One thing that we could do with a company like this is we could project the growth rate, which is 70%. But if you see the last 5 years, it's 42%. So it's actually accelerating its growth, which is also very, very good. So Robinhood is definitely a very good candidate to invest. But you're paying a fair price based on the growth and the market that's there now. If the market decides to go down, then Robinhood will probably go down faster. That's the way it works. High growth companies, they are higher valued, and then when the market crashes, they would also crash faster. But if you're a growth investor, that's okay, because the market, when they recover, your stock will recover faster typically too. So that's one thing to consider. One thing that we can do is we can use discounted cash flow analysis to see what the intrinsic value would be. So if we are to do that here and we project growth of, let's say, 45%, because that's what we saw, based on the 5-year average. So we go here to, the free cash flow, and we're going to project it 45%. Actually, we need to start probably with a similar value as here. So you're at around 1 billion. So we need to start at around 1 billion. And then we're going to project growth of like 45%. This takes a while. Normally you don't have to do this, but okay. So now basically what it's doing is it's taking these 5-year free cash flows and it's going to sum that up. And then for the long-term projections, we're going to look at the cost of capital. So this is currently the risk-free rate. This is the market premium. Okay. All right, that seems okay. Long-term growth rate. Yeah, and then we see if we just use, the discounted cash flow analysis, then we see that actually the market price is too much, even with the growth rate of 45% year over year. So that's just based on free cash flows, right? So the earnings is one thing, but how much are you as a shareholder able to take home? So free cash flow is a very important indicator for that. And you see here that they're heavily investing in the business. So if you look at where their expense is, are we able to find out why? Not able to make sense out of this. But again, we can look here, right? If we look at, for example, the business outlook. So again, this will basically analyze the annual report, and it will probably come up with their strategy of how they're going to grow the business. So we have indeed seen that their business has accelerated its growth. So that's very good. Now we can look at, what the owners are thinking to do with the business going forward. Usually it takes a minute or two. In the meantime, maybe we can quickly look at the other companies. So AppLovin, what do they do? So they make software based for mobile app developers to basically do marketing and monetization of their apps. So they are basically a platform for app developers to sell and market their apps, as the name implies. And yeah, if you look at their earnings, I mean, it's quite incredible. So we're looking at 150% earnings increase and about 28% revenue increase. So again, if you compare this with Microsoft's benchmark, this is of course a much higher growth company. But right off the bat, I can see the valuation is much higher. Compare that with the S&P. Or let's compare it actually with Robinhood, right? So we see that Robinhood's actually growing faster and is cheaper. So if you just compare these two, we can actually conclude that Robinhood would be the better choice to invest in. And both of them have, by the way, very, very good margins. Like 50% is really as good as it gets in terms of public companies. So both of them are very good, but App is more expensive. Now, if you go back again to Robinhood and we look at the business outlook, so we see that the company plans to invest in technology, adopt AI tools, including AI native advisory products to enhance its offering. So of course, AI needs to be included in all businesses going forward, and Robinhood is no exception. Expectations to lead in cryptocurrency and blockchain technologies with new product launches aimed at driving tokenization, aimed at becoming the #1 retail trading platform across all asset classes, with a focus on expanding product offerings. Anticipates that as customers grow their wealth, they will deepen their relationship with the platform, creating opportunities for revenue growth. Plans for international expansion, including new offerings in the UK and an office in Singapore. Pending acquisitions of Bitstamp and Trade PMR are expected. Okay, so we can look at this very closely to see the bullet points of what's going on with the business. Again, the more we understand the business, the more confidence we have. So Robinhood is a company that's high growth. Yes, it is. It has 50% price to earnings, so it's highly valued, but that's normal in a market where, high growth companies, they are valued higher, like I said earlier. So I would say 50 is reasonable, to be honest, for a company like this. Like, you're not going to find companies that are in the S&P 500, high growth, such as Robinhood, where they have 70% revenue growth. You're not going to find it for 30 price to earnings. You're just not going to find it. Then you have to look at companies outside of the S&P 500. So that's what we were doing earlier. We were looking at the Russell 2000 to find companies that have all the check boxes for us. So we're looking for companies that we can understand. We're looking for companies that have high growth. We're looking for companies that are fairly or undervalued. And then we can invest in them. And then we are finding, 10 to 15 of those. And that's what we do. We hold all of them. We hold them for how long? Well, that depends on what the price does. That depends on the news. But if you're like me, I don't look at these companies day to day. I probably, hold them, and I probably plan to hold them for a year, 2 years, 3 years, or maybe even longer. And then, I can sleep well at night, knowing that I have companies that are highly growing, and I have, 10 to 15 of them. Then if, one shows growth, but actually the price is going down, it doesn't bother me. I can just keep holding it. Like, one good example is a company in Latin America. It's called Mercado Libre. So the price has not been doing well this year. As you can see here, the price has not been doing well. Right off the bat, I can see actually that right now it's at a support level. So if you're listening to this could be a good entry point for you to buy. Why? All right, we're back. We had a battery issue, so now we have a new battery. So, okay, I think I was talking about Mercado Libre. Yeah, so the first thing I see when I open this up is that it's actually at the bottom of a support line. So if you're looking to buy Mercado Libre, this could be a good entry for you, potentially. Or you can wait for a new higher high and higher low. Like, that would actually be a better entry. So you have to wait to see a higher high and then a higher low. And then that will be your perfect entry, to be honest. because then it confirms that we did not break this resistance point. But why is this actually a good company? Well, look here at the revenue. So it's very, very stable in terms of growth. And it's, of course, a very high growth company. We're looking at 38% year-over-year growth. So this is a very interesting company. But if we compare it with Robinhood, we see that actually the earnings ratio is about similar. So with Robinhood, you're getting higher growth and you're getting similar valuation if you just look at the price to earnings ratio. And Robinhood also has a higher profit margin of 52%. So this can be included in your portfolio, in your range of companies. It's an e-commerce company and everything related to e-commerce. It has way more things like online paying platforms and stuff like that. And it's operating outside of the US. It's primarily focused in Latin America, competes with Amazon. It's basically the Amazon of Brazil and other Latin American companies. So, yeah, for me, like I have had a decline you can see here, right? So 21% just in 6 months. But I'm very comfortable holding this company because I know that this growth will continue and that the price will go higher. So I will be very comfortable buying it here. In fact, I think it's a great opportunity to buy. You can indeed wait for the next opportunity, which would be even better. But yeah, this is one of those companies that I hold. So we were looking at Robinhood and we had selected a few others. Like one is AppLovin. So AppLovin is also a company that I hold. And I made quite a bit of money on this. You can see that it had quite the run up earlier this year. And it's still high now. And, you know, the first thing I always look at is the top line. Like, how much is this actually growing? So we see that the growth is about 28% year over year. The last 2 years compounded, it's 35%. So this is a high growth company. And again, the benchmark for me, at least, is Microsoft. You need to find companies that are better than Microsoft. Like companies like Microsoft, Google, Amazon, they have a couple of advantages. They have already distribution network. They're already embedded. They have sales teams. So we have seen that with Zoom, for example. Zoom came out. Google came with Google Meets. Microsoft came with Microsoft Teams. So they already have all the talent in-house to replicate businesses and then directly distribute it to their existing customers, package it with Office 365, for example. So for me, Microsoft is like the benchmark. If you're looking to invest in a company, it needs to be better than Microsoft. So AppLovin has much higher growth than Microsoft, as well as Robinhood does. And if you look at the profit margins, this is very, very healthy. Again, Microsoft is the benchmark, so let's compare it with Microsoft. And Microsoft also has very, very good profit margins, 35%, but 50%, that's about as good as you can get. So that's all very healthy. Now, of course, you're paying a premium for AppLovin, 83. So would I buy it here? No, I would not buy it here. We've seen that Robinhood had 50, so Robinhood is a much better purchase at this point. But you can definitely keep this in your watch list. Like if you had bought this here, like that would have been perfect, actually. You know, we see here, like this was in November, so it's almost 3 months ago. But yeah, a month ago was 21%. So you could probably have just made 25% or so in this run up here. But would I buy it here? No. I would probably, look at the trend, zoom it out a bit, and anywhere where it would get close to this blue line, like that would be a perfect entry in my opinion. And then you just buy and hold. A company like this will keep growing. As far as I know, they are a market leader. And, once you buy or once you decide to invest, try to understand what the business does, what the management is saying, so you can find that here in the quarterly reports. It's very easy to summarize now with AI. And then you can learn more about the business. I mean, there are only 4 quarterly earnings per year. Yes, you can be on top of the news. That's also one thing. But you don't have to do that. As long as you find, many companies, you don't have to be on top all the time. You can get 1 or 2 companies in your portfolio that drop like 10% because of a negative earnings. And you can sustain that. There's no problem in having 1 or 2 of those moments per year. It's not really a problem. As long as you have enough companies that are all high growth, then you can still outperform the market. So while it's summarizing, let's go to the next one that we selected, which is Coinbase. So Coinbase price has gone up and down. And let's have a look at the earnings and revenue. Yeah, so earnings is also up and down. And the revenue, as we see, yes, it has very high growth compared to last year, even 2 years ago. But it has seen quarters where it had more revenue than today. And my guess is that this is probably very closely related to the Bitcoin and crypto price. So as there is more crypto, I think that the crypto activity is related to the price and to the sentiment. So if my thesis is correct, so here we have, December 2024, then we should see, in this quarter that there's a reason why people are buying crypto. So here I have the Bitcoin price, and if we go to December 2024, we indeed see that in this quarter, we have seen this massive run up. So we have the first wave, then the second wave. So of course, this will be a very profitable quarter for them. But now, for example, we see a decline. And if you just look at their revenues, it's actually declined since that point. So this tells me that, the crypto investors are getting less active. And this could also be bad for the Bitcoin price. Yeah. Now let's compare this with Robinhood. So we see that Robinhood is growing faster, top line, is growing faster net income, because the earnings per share, the earnings means net income per share. Coinbase is cheaper though, quite a lot, more than half, if you just look at the price to earnings. And I would say this is the major benchmark you can look at. You can look at other things too, like book value and such things. But investors are mostly interested in earnings, though earnings can be manipulated with accounts receivables, as we've seen with NVIDIA, for example. So both profit margins are very healthy. Even 44% is very, very good. Very, very good. If you see the S&P's average, it's 12. So you can benchmark it against that. So basically the average company within the S&P 500, 12.9, 13%, Coinbase 44.7. So Coinbase is a good company, but the growth is a bit erratic. It's not predictable. It seems to be related to the Bitcoin price. So if you're so confident that the Bitcoin price will go higher, then maybe yes, this could be a good buy if you expect this to go higher. But to me, just comparing, Robinhood with Coinbase, it seems that Robinhood would be the better company in this case. And also we know about their expansion plans in the UK and Singapore, for example. Now, what else should we do? Yeah, recently maybe we can just cover some news. So last week, actually this is not the right dashboard. Last week, the Fed decided to cut interest rates. So we're now at the federal funds rate of 3.64. They also decided to do QE. Me, I am aware what they do. I'm not fully on top of it. I'm more interested to find, high quality growth companies or undervalued companies and focus on those. Then I generally check the S&P, what the S&P is doing. And for example, in volatile times like this, what I tend to do is I may hedge my portfolio by putting on SQs. So SQs is basically short Qs. Qs is the NASDAQ 100. My companies in my portfolio, they're all typically high growth. So this correlates very well with the NASDAQ 100. So if I know, for example, that the market is going to go down, then instead of, maintaining these 10, 15 positions, because that's quite a hassle, I put on SQs to basically hedge. SQs is 3 times leveraged. So you need, for full hedging, basically you can do 1/3 of the size of your portfolio in SQs. So I always keep a bit of cash laying around so that I can do that. And then when I know that, okay, we hit a bottom, like I caught this one almost perfectly, I put on TQs. And TQs is basically leveraged Qs. And yeah, I made some good money on this trade with the TQs. But for the most part, I find high quality growing companies that I understand and that I know will do well in the coming years. So that's mostly what I do. Well, this was episode 1. I hope you liked it. Like and subscribe, and I'll see you next week.